everyone, welcome back to Mindful Investing. Today, I want to talk about a question that's confusing many investors. Why is Amazon stock moving sideways or even down 2% this year while most of the big tech names like the Magnificent Seven have been climbing higher? And more importantly, should you buy Amazon before their next earnings report? And I currently own 22 shares of Amazon at an average price of $195, and I'm up about 10% so far. And based on my model, I see around 22% upside in 1 year and over 170% upside in 5 years, which puts Amazon stock near $587 from today's price of roughly $215. But this isn't just a speculation. I'll walk you through the balance sheet, growth hurdles, what to watch in the upcoming earnings, and whether this sideways move is a signal or an opportunity. Let's start by looking at Amazon's financial strength first. Because before we talk about growth, AI, or AWS, it's important to understand just how powerful Amazon's balance sheet really is. Here are the key numbers from the most recent filings. Amazon currently has a total debt of $133.9 billion dollars, and the total cash position is $60.58 billion dollars, and cash equivalents of another $101.2 billion dollars in near cash investments. So with these numbers, the net debt comes down to negative $27.9 billion dollars. They have a free cash flow of $13.48 billion dollars, and finally the debt to free cash flow ratio is negative 2.07. So what does all that actually mean? Let's break it down. First, Amazon's cash pile is bigger than its total debt. In simple terms, it could pay off every dollar of debt right now and still have billions of dollars left over. Very few companies in the world are in that kind of financial position. And second is that their $13.48 billion in free cash flow is what fuels long term growth. It's the cash Amazon keeps after covering its day to day expenses and investments. This gives them the freedom to invest in new technologies, expand AI infrastructure, open more fulfillment centers, or even buy back shares, all without needing to buy more money. And the third is their negative debt to free cash flow ratio. Shows Amazon is not under financial pressure at all. In fact, it's operating from a position of strength. That means the company can take smart risks even when competitors are forced to pull back. This is the part many investors miss. While headlines often focus on slowing growth or raising competition, under the surface, Amazon's balance sheet is rock solid, strong enough to support the next decade of innovation and expansion. However, financial strength alone isn't enough to guarantee strong stock performance. Amazon still has to deliver by growing AWS, making real progress in AI, and keeping its retail and logistics operations efficient. And that brings us to the next big question. Can Amazon actually turn this financial strength into faster growth? That's what we'll dive into next. Amazon's future, at least from an investor lens, is increasingly defined by AWS, its cloud and AI powerhouse. Retail and e commerce are now mature and stable. They keep the engine running, but AWS is where the next wave of growth, profitability, and valuation expansion will come from. Here's what the market is watching closely right now. Analysts are expecting AWS to grow around 18 to 19% over the next year. Many believe 20% year over year growth is the magic number for AWS. And this is the point where Wall Street regains confidence and the stock starts to re rate higher. Last quarter, AWS reported 17.5% growth, which sparked some skepticism about its ability to capture the rapidly expanding AI workload opportunity. The cautious view is that competition from Microsoft Azure and Google Cloud, plus the trend toward multi cloud adoption, could limit acceleration in the near term. But here's where I stand, and this is key. I believe AWS can hit the 20% growth mark in the next year or two because the building blocks are already in motion. Projects like Rainer, which is ramping up new data center capacity, and Trainium 3, Amazon's next gen custom AI chip, expected to deliver 4 times the performance of the previous model. This will play a crucial role. These aren't just incremental upgrades, they are foundational moves that position AWS to handle larger AI workloads more efficiently and at lower cost. Add to that Amazon's growing ecosystem of tools like Bedrock and Q, which are steadily gaining adoption among developers, and it's clear that AWS isn't lagging. It's quietly setting up for a breakout. we are seeing many analysts remain divided actually. Some see 18%, others 19%, and a few think 20% is still a stretch. But from my model and looking at how AWS has historically executed during capacity buildouts, I believe we could see a re-acceleration once these new AI-driven data centers come online. So, in my view, the story isn't about whether AWS is slowing down, it's about how quickly it can scale its AI infrastructure. And that's the part Wall Street often underestimates because once AWS crosses the 20% growth threshold, sentiment can flip almost overnight. And that's when Amazon stock could see its next big leg higher. So the big question is, why has Amazon stock been lagging behind the rest of the Magnificent Seven? It's up only about 2% year to date, while peers like Nvidia, Meta, and Microsoft have surged double digits. Let's unpack the main reasons driving this sideways movement. Number one is high expectations are already baked in. At Amazon's scale, a lot of optimism is already priced in. Investors expect consistent growth across retail, ads, and AWS, so even solid results can come across as underwhelming. In other words, Amazon is a victim of its own success. To really move the needle, it needs positive surprises, not just steady execution. And the second thing is AWS growth skepticism. Last quarter's 17.5% AWS growth wasn't bad, but it wasn't the 20% figure the market was hoping for. And since AWS drives most of Amazon's operating profit, any deceleration there hits the entire valuation. Investors want proof that Amazon can scale its AI and cloud businesses at the same pace as its peers. And until they see that, many are staying on the sidelines. And the third reason is competition and multi cloud pressure. We are also seeing a clear multi cloud shift in enterprise spending. Companies aren't going all in with a single provider anymore. They are spreading workloads across AWS, Azure, and Google Cloud. That means AWS growth will likely be more measured, especially in the near term. But remember, this doesn't mean the business is shrinking. It just means the growth curve is flattening as the market matures. Number four is the raising short interest and sentiment pressure. Here's where it gets interesting. Amazon's short interest has increased nearly 10% recently, now standing at about 0.8% of total float. That's roughly 77 million shares sold short. Now, that's not alarmingly high, but it's a clear signal of growing bearish sentiment. Traders are betting on stagnation rather than decline. But here's the flip side. When you combine low absolute short interest with rising bearish positioning, you get a setup where even a small piece of good news like AWS re-accelerating or retail margins improving can trigger a sharp sentiment reversal. So while short interest might look negative on paper, it can actually become fuel for a relief rally if expectations prove too pessimistic. Number five is their AI leadership perception. Finally, perception around AI matters. Wall Street now judges every tech giant through an AI lens, and Amazon is often compared to Nvidia, Microsoft, and Google. Whenever there's news of delays in chip rollouts or slower adoption of Amazon's AI tools like Bedrock or Nova, the stock tends to get punished disproportionately. But from an investor standpoint, these are execution timing issues, not structural weaknesses. Once Amazon's AI infrastructure like Project Rainer and Trainium 3 scales, we could see a meaningful re rating in how the market values the company's AI potential. Bottom line, I think Amazon's recent underperformance isn't about a broken story, it's about timing and sentiment. The fundamentals remain strong, but the market wants proof of acceleration, especially in AWS and AI. Once those catalysts align, Amazon stock could easily transition from consolidation mode to its next growth phase. So here's how I'm personally approaching Amazon from here. I already own 22 shares at an average price of $195 and I'm currently up about 10%. But even at these levels, I see more upside than downside. As per my model, Amazon has an upside of around 22% in 1 year, putting it close to $262 and a potential 172% upside over 5 years, which would take the stock to roughly $587, assuming AWS accelerates growth toward that 20% mark and retail margins continue improving. Now, looking at the technicals, the stock is approaching its 20-day EMA on the daily chart, which currently sits around $210. That's an important support level for long-term investors. So I'll be adding a few shares near the $210 level. And if it dips below the $200 level, I'll be more aggressively buying to average down. Because fundamentally, Amazon's balance sheet is very strong, cash flows are positive, and sentiment is overly cautious. That's exactly when I prefer to accumulate high quality names. If AWS re-accelerates and AI adoption strengthens, Amazon could surprise the market in a big way heading into 2026. So my plan is to buy near $210 and add more under $200 and hold long term for 2x potential. And in my view, the story isn't broken. It's just early in the next cycle of growth. And that's my thesis behind Amazon's move. So, what do you think? Is Amazon's sideways trend a hidden opportunity, or is it signaling that the growth ceiling is already priced in? Drop your thoughts in the comments below. I'd love to hear how you are positioning around Amazon heading into earnings. And if you found this breakdown helpful, hit like, subscribe, and turn on notifications so you don't miss more deep dives like this. Thanks for watching, and as always, invest smart, stay patient, and I'll see you in the next one.